They didn't ring a bell. They didn't send you a notification. They didn't go live on television to warn you. But quietly, strategically, and with absolute intention, they just moved $4 trillion into gold. And whenever money moves at that scale, it is never random. It is preparation. It is foresight. It is power positioning. Today's question is not what they did. The real question is why they did it, and more importantly, what they know that most people don't. When capital moves at the scale of trillions, it is never emotional and it is never accidental. A 4 trillion shift into gold represents a deliberate response to rising systemic risk across the global financial architecture. Institutions that manage national reserves, sovereign wealth, and long-term liabilities do not chase narratives. They respond to structural stress. This movement signals that key decision makers are identifying vulnerabilities in the current system that cannot be resolved through short-term policy tools or market optimism. At the core of this risk is the growing imbalance between debt and economic output. Global debt levels have expanded far faster than productivity, creating a situation where growth is increasingly dependent on borrowing rather than value creation. This model functions only as long as confidence remains intact. Once investors begin to question whether future growth can realistically service existing obligations, capital seeks protection. Gold historically absorbs this demand because it is one of the few assets that sits outside the debt-based system entirely. Another critical driver is the declining effectiveness of monetary policy. Central banks have relied heavily on low interest rates and liquidity injections to stabilize markets, but these tools lose power over time. When rates remain suppressed, real yields often turn negative, quietly penalizing savers and long-term holders of cash and bonds. Institutions understand that negative real rates are not temporary anomalies, but structural features of a highly leveraged system. Gold, which does not rely on yield but on preservation, becomes increasingly attractive under these conditions. There is also a growing awareness that market stability is being maintained through intervention rather than organic balance. Asset prices appear resilient, yet that resilience is heavily dependent on policy support. This creates a fragile equilibrium where markets function well until they don't. Large gold allocations reflect an understanding that intervention can delay risk, but it cannot eliminate it. When support mechanisms are withdrawn or lose credibility, the adjustment is often sudden and severe. Gold functions as a buffer against that abrupt repricing. Geopolitical uncertainty further amplifies systemic risk. Trade fragmentation, sanctions, and financial weaponization have introduced new variables into global finance. Assets that were once considered secure can now carry political risk. Institutions are increasingly aware that access to reserves, payment systems, or foreign-held assets may no longer be guaranteed during periods of conflict. Gold, held directly in outside foreign jurisdictions, reduces exposure to these non-economic risks. This is not paranoia, it is contingency planning at the highest level. Here is the uncomfortable hook most people overlook: the system does not warn you before it stresses you. By the time instability becomes visible in employment data, currency markets, or consumer prices, protective assets are already repriced. Institutions do not wait for confirmation, they act on probability. The scale of this gold movement indicates that the probability of systemic disruption is being reassessed upward, even if public messaging remains calm. Liquidity risk is another factor driving this shift. In periods of crisis, markets that appear deep can suddenly become illiquid. Assets tied to complex financial structures may face pricing gaps or forced selling. Gold's liquidity during crisis, especially at the institutional level, makes it a reliable reserve asset when other markets seize up. This is not about fear, it is about maintaining optionality when normal market functions are impaired. What makes this signal particularly powerful is its timing. This accumulation is occurring while headline indicators still suggest stability. Employment remains resilient, equity markets continue to function, and official inflation measures appear contained. Yet capital is already repositioning. That disconnect is the signal. When those closest to systemic risk adjust their portfolios before stress becomes visible, it suggests that current stability is being viewed as conditional rather than durable. The most important insight is this: systemic risk does not arrive as a single event. It builds quietly through imbalances, policy exhaustion, and shifting incentives. Gold accumulation at this scale is a response to that slow build, not a reaction to a crisis already underway. It reflects a recognition that the margin for error is shrinking and that traditional safeguards may no longer be sufficient. The real hook is not the gold itself. It is the message behind the move. When institutions prioritize preservation over performance, it signals a change in expectations. They are not preparing for opportunity, they are preparing for resilience. And in economics, resilience is only prioritized when the cost of instability is expected to be high. confidence is the invisible foundation of every fiat currency system. Unlike assets with intrinsic value, fiat money functions because people collectively agree to accept it in exchange for goods, services, and labor. When that confidence is strong, currency circulates smoothly and economic activity expands. When confidence weakens, the entire system becomes fragile. The growing shift away from fiat currencies is not sudden or emotional. It is the result of long-term structural pressures that have steadily eroded trust in how modern money is created and managed. One of the primary sources of this erosion is persistent monetary expansion. Over time, the supply of fiat currency has grown far faster than the real economy. While this expansion is often justified as necessary for stability or growth, its long-term effect is dilution. Each additional unit of currency reduces the purchasing power of those already in circulation. This process rarely feels dramatic in the moment, which is precisely why it is effective. Inflation does not announce itself as a crisis. It appears gradually, normalized through rising prices and adjusted expectations. Here is the hook most people miss: inflation is not just an economic outcome. It is a behavioral tax. It penalizes those who save in cash and rewards those closest to the source of new money. Institutions understand this asymmetry. They recognize that prolonged inflation, even at moderate levels, undermines the credibility of a currency by making long-term planning more difficult. When money cannot reliably store value, it stops functioning as money in its purest sense. Fiscal behavior has compounded this problem. Chronic deficits and expanding public debt signal to markets that governments are increasingly reliant on future money creation to meet present obligations. While debt can support growth when used productively, excessive reliance on borrowing shifts confidence from output to assumption. The question quietly forming in institutional circles is not whether debt can grow, but whether it can ever realistically be reduced without undermining economic stability. When the answer becomes uncertain, trust begins to fracture. Another pressure point is the politicization of monetary systems. Currencies are no longer perceived as neutral tools of exchange. They are increasingly instruments of policy and leverage. Capital controls, sanctions, and regulatory interventions introduce political risk into what was once considered purely financial space. For global investors and central banks, this changes the calculus. A currency that can be restricted, frozen, or redefined by policy is no longer a purely economic asset. It carries governance risk, and that risk must be priced in. The credibility of central banks has also shifted. For decades, these institutions were viewed as independent guardians of price stability. Today, their mandates have expanded, and their actions are often constrained by political and social pressures. When inflation persists despite tightening measures, or when policy reversals occur rapidly, markets begin to question whether long-term discipline is still achievable. This does not require failure, it only requires inconsistency. Confidence weakens not when institutions collapse, but when predictability disappears. Here is the second hook: currencies do not fail all at once. They fail by becoming less useful over time. When individuals and institutions begin to seek alternatives for saving, hedging, or settling value, it signals that money is losing one of its core functions. Gold re-enters the conversation not because it promises growth, but because it offers stability in a system where stability feels conditional. Global coordination challenges further intensify this erosion. In a fragmented world, monetary policies diverge sharply, creating volatility across exchange rates and capital flows. This volatility increases uncertainty for trade, investment, and reserve management. Fiat systems rely on cooperation and credibility across borders. When that cooperation weakens, confidence does not collapse, but it leaks slowly, persistently, and predictably. The most revealing signal is not public sentiment, but institutional behavior. When reserve managers, long-term funds, and central banks diversify away from fiat dominance, they are not making ideological statements. They are responding to risk models that increasingly account for debasement, policy unpredictability, and geopolitical exposure. These shifts rarely make headlines until they are well underway. The uncomfortable truth is that fiat currency systems depend on discipline that becomes harder to maintain as obligations grow. Erosion of confidence does not require mismanagement. It emerges naturally when systems are stretched beyond their original design. Gold, by contrast, requires no credibility. It does not depend on promises, forecasts, or policy discipline. That contrast is what makes the erosion visible, not in words, but in capital flows. Inflation quietly reshapes an economy long before it is fully recognized. It does not arrive as a single shock, but as a gradual erosion of purchasing power that alters behavior, incentives, and long-term planning. While public attention often focuses on short-term price movements, institutions evaluate inflation through a different lens. They assess its cumulative impact over years, not months. This is where gold's role becomes critical not as a speculative asset, but as a strategic hedge against the slow, persistent effects of inflation that undermine real wealth. One of the most important dynamics in this process is the relationship between inflation and real interest rates. When inflation exceeds nominal yields, holders of cash and fixed income instruments experience a silent loss, even if account balances appear stable. Negative real rates effectively transfer value away from savers without requiring explicit policy announcements. Institutions recognize that such environments are not temporary distortions, but structural features of heavily indebted systems where raising rates too aggressively risks destabilizing growth. Gold becomes relevant precisely because it does not rely on yield. Its function is preservation rather than income generation. Here is the first hook most people overlook. Inflation does not need to be high to be destructive. It only needs to be persistent. Even modest inflation, compounded over time, significantly reduces purchasing power. For long-term investors, pension funds, and central banks managing reserves, this compounding effect is unacceptable. Gold's historical ability to maintain real value across inflationary cycles is a logical counterbalance in portfolios designed for durability rather than short-term performance. Another key factor is the asymmetry of inflation's impact. Inflation does not affect all assets equally. Some assets benefit temporarily, others lag, and many fail to keep pace once inflation becomes embedded. Gold's appeal lies in its neutrality. It is not tied to corporate earnings, consumer demand, or credit conditions. Its value adjusts as the measuring unit, currency, changes. In this sense, gold does not rise in value. The currency used to measure it declines. This distinction is subtle, but it is fundamental to understanding why gold functions as an inflation hedge rather than a growth asset. Policy responses further reinforce this dynamic. When inflation accelerates, central banks face a narrow corridor of acceptable action. Aggressive tightening can suppress inflation but risks financial instability and recession. Insufficient tightening preserves growth but entrenches inflation expectations. Institutions understand that policymakers often choose the path of least immediate disruption, even if it allows inflation to linger. This creates an environment where inflation risk is asymmetric to the upside, increasing the strategic value of assets that perform well under prolonged monetary accommodation. Here is the second hook. Inflation hedging is not about predicting price spikes. It is about managing policy limitations. Gold performs best not when inflation is surprising, but when it is tolerated. That tolerance, once embedded, becomes a powerful force in capital allocation decisions. Gold also plays a unique role in expectations management. Inflation is as much psychological as it is mathematical. When confidence in purchasing power weakens, demand for stable stores of value increases. This demand is self-reinforcing. As more capital seeks refuge in assets perceived as stable, their role in portfolios becomes institutionalized rather than opportunistic. Gold's long history as a store of value gives it credibility that newer hedging instruments have not yet earned. The global nature of inflation further enhances gold's appeal. Inflationary pressures are rarely confined to a single economy, especially in a world of interconnected supply chains and synchronized monetary responses. Gold operates outside national boundaries. It does not depend on the credibility of any single central bank or fiscal authority. For institutions managing international exposure, this universality is a critical advantage. What distinguishes institutional gold accumulation from retail interest is intent. Institutions are not attempting to time inflation peaks or trade volatility. They are embedding resilience into balance sheets. Gold allocations are often designed to sit quietly, performing their function without constant adjustment. This long-term orientation underscores the role of gold as a hedge, not a bet. The most revealing insight is that gold's relevance increases when inflation becomes normalized rather than feared. When rising prices are accepted as a permanent feature of the economic landscape, the search for protection becomes structural. Gold's role in this context is not dramatic, but it is decisive. It absorbs inflation risk over time, preserving purchasing power when other assets are forced to adapt. Geopolitical fragmentation has become a defining feature of the modern economic landscape, and its influence on capital allocation is deeper than most public discussions acknowledge. As global relations shift from cooperation to competition, financial systems are increasingly shaped by strategic interests rather than pure efficiency. This environment elevates risk in places once considered stable and forces institutions to reassess how and where they store value. The growing demand for neutral assets reflects this reassessment, and gold stands at the center of that shift. One of the most significant changes is the redefinition of financial security. Assets are no longer evaluated solely on liquidity, yield, or creditworthiness. They are now judged by their exposure to political influence. Sanctions, asset freezes, and access restrictions have demonstrated that ownership does not always guarantee control. This realization has altered institutional behavior. Gold, when held directly, removes counterparty risk and reduces dependence on foreign legal systems, making it uniquely attractive in a fragmented geopolitical environment. Here is the first hook that reshapes the conversation in a divided world. Safety is no longer about size or reputation, it is about independence. Financial assets tied to any single jurisdiction inherently carry political risk, regardless of their historical stability. Gold's neutrality allows it to function as value without allegiance, which is precisely why it becomes more valuable as global trust declines. The weaponization of financial infrastructure has accelerated this trend. Payment systems, reserve currencies, and international clearing mechanisms are increasingly used as tools of influence. While effective in the short term, this approach introduces long-term consequences. Nations and institutions begin to seek alternatives that reduce vulnerability to external pressure. Gold does not require access to payment networks or permission to be transferred. Its value is recognized across borders without reliance on intermediaries. Trade fragmentation further reinforces this demand. As supply chains regionalize and trade blocs form, currency exposure becomes more complex. Exchange rate volatility increases, settlement risks grow, and hedging costs rise. Gold acts as a stabilizing asset in this environment, providing a common denominator of value that is not directly tied to trade imbalances or bilateral agreements. This function becomes increasingly important as global commerce moves away from uniform frameworks toward fragmented arrangements. Here is the second hook: neutrality becomes most valuable when alliances feel conditional. In uncertain geopolitical climates, institutions prioritize assets that remain valid regardless of shifting partnerships. Gold retains acceptance even when diplomatic relationships deteriorate. That universal recognition is not symbolic, it is operational. Another layer of fragmentation lies in regulatory divergence. Financial rules, capital controls, and reporting requirements are evolving differently across regions. This divergence creates friction in cross-border investment and reserve management. Assets that operate outside complex regulatory webs reduce administrative risk and compliance uncertainty. Gold's simplicity, its lack of contractual obligations or embedded policy conditions, makes it efficient in an increasingly complex regulatory environment. Central banks have been particularly responsive to these dynamics. Their reserve strategies reflect not just economic forecasts, but geopolitical risk assessments. When reserve diversification accelerates, it signals a reassessment of what constitutes true safety. Gold's increasing share in reserves suggests a recognition that political neutrality is now a core component of financial resilience. The psychological dimension of fragmentation cannot be ignored. Confidence between nations influences capital flows as much as formal agreements. When trust weakens, institutions seek assets that do not depend on mutual confidence. Gold's value does not require coordination or enforcement. It exists independently of collective belief systems. This independence becomes a powerful anchor when confidence is fragile. The most revealing aspect of this shift is its quiet nature. There are no dramatic announcements or public declarations. Instead, reserve balances adjust, storage facilities expand, and long-term strategies evolve. These changes indicate a structural response to a world where geopolitical risk is no longer an exception, but a baseline assumption. The deeper insight is that fragmentation does not need to escalate into open conflict to influence economic behavior. The mere possibility of disruption alters incentives. Gold's role as a neutral asset allows institutions to operate within this uncertainty without taking sides. It offers continuity in a system increasingly defined by division, and that continuity is now being priced into global capital allocation decisions. Institutional gold purchases are often misunderstood because they are evaluated through a retail or speculative lens. Many assume that when large entities buy gold, they are making a directional bet on price appreciation. In reality, for central banks, sovereign funds, and large institutions, gold accumulation is primarily a function of risk management. It is not about outperforming markets in the next quarter. It is about ensuring balance sheet stability across economic regimes that may look very different from today. The first distinction to understand is intent. Speculation seeks upside by accepting volatility. Risk management seeks continuity by reducing vulnerability. When institutions allocate to gold, they are not attempting to time inflation spikes or currency collapses. They are acknowledging that uncertainty itself has increased. Gold becomes valuable not because something bad has already happened, but because too many critical variables are no longer predictable with confidence. Here is the first hook that changes the narrative. Institutions buy gold when they are less confident in forecasts, not more confident in outcomes. In an environment where growth projections, policy paths, and geopolitical relationships can shift rapidly, assets that rely on stable assumptions become fragile. Gold does not require a forecast to function. Its role is to remain relevant regardless of which scenario unfolds. Portfolio construction at the institutional level is driven by correlation, not conviction. Assets are evaluated based on how they behave relative to each other under stress. Gold has historically demonstrated low or negative correlation with equities, credit, and fiat currencies during periods of disruption. This makes it a stabilizer, not a driver, within diversified portfolios. Institutions are willing to accept that gold may underperform during periods of rapid growth, because its value emerges precisely when other assets struggle. Another critical factor is balance, sheet resilience. Institutions with long, dated liabilities must ensure that assets remain liquid and credible under extreme conditions. Financial instruments tied to counterparties, leverage, or complex contracts introduce layers of dependency. Gold simplifies this equation. It carries no default risk, no maturity risk, and no dependency on issuer credibility. In times of stress, simplicity becomes an advantage, not a limitation. Here is the second hook: most people overlook the absence of yield is not a weakness when the goal is survival, not optimization. Yield-bearing assets assume functional markets and enforceable contracts. Gold assumes nothing. That assumption gap is precisely why institutions retain it, even when alternative assets appear more productive during stable periods. Regulatory and accounting considerations also play a role. Gold is treated differently from many financial assets in capital adequacy frameworks. It is often assigned favorable risk weightings and can strengthen perceived balance sheet quality. For central banks, gold enhances credibility by signaling prudence and independence. For large institutions, it provides a form of capital insurance that does not rely on external guarantees. Liquidity during crisis conditions further reinforces gold's defensive role. Markets that appear deep during normal times can become disorderly under stress. Forced selling, margin calls, and funding freezes expose hidden fragilities. Gold has historically retained liquidity even during systemic shocks, allowing institutions to rebalance or raise capital when other options are constrained. This liquidity characteristic is not theoretical. It is embedded in decades of crisis behavior. The time horizon of institutional decision-making is another key distinction. These entities operate across cycles, not headlines. A gold allocation may remain unchanged for years, quietly fulfilling its function without drawing attention. This long-term orientation means gold is not judged by short-term price movements, but by its contribution to overall risk reduction. In this context, stability itself becomes the return. There is also a signaling dimension to consider. When institutions hold gold, they communicate discipline to markets and stakeholders. It signals that preservation of value is prioritized alongside growth. This signaling effect can enhance confidence during uncertain periods, reinforcing institutional credibility even when external conditions deteriorate. Perhaps the most revealing hook is this: institutional gold buying often increases when optimism is still publicly dominant. This is because risk management is most effective when implemented early. Waiting for confirmation defeats its purpose. By the time volatility becomes obvious, protective assets are already repriced, and the cost of safety rises sharply. Ultimately, gold's role in institutional portfolios is defensive by design. It exists to absorb uncertainty, not to amplify opportunity. This distinction explains why large gold allocations often coincide with periods of apparent calm. Institutions are not reacting to crisis. They are preparing for the possibility that current stability is more fragile than it appears. Early positioning is one of the most consistent patterns in economic history, yet it remains one of the most misunderstood. Major financial shifts are rarely sudden from the perspective of institutions. They unfold gradually through signals that are invisible to the public eye. When large players adjust their exposure well before economic stress becomes obvious, they are not acting on rumors or emotion. They are responding to leading indicators, internal models, and probabilities that suggest future instability long before it appears in mainstream narratives. The first reality to understand is that institutions operate on information cycles that differ fundamentally from those of the general public. They monitor capital flows, reserve changes, settlement risks, and policy constraints in real time. These data points do not make headlines, but they reveal stress building beneath the surface. When these indicators begin to align, early repositioning becomes a rational response. Gold accumulation often reflects this alignment, serving as a quiet adjustment rather than a public statement. Here is the first hook most people miss. By the time risk feels real, protection is already expensive. Markets price fear quickly, but they price preparation slowly. Institutions understand this asymmetry and act accordingly. They accept the cost of early positioning because the cost of late action is far greater. Another critical factor is narrative lag. Public perception of economic conditions is shaped by official statistics and media framing. both of which tend to reflect past conditions rather than emerging risks. Employment figures, inflation reports, and growth data are backward-looking by nature. Institutions, however, focus on forward-looking constraints such as debt servicing capacity, liquidity availability, and policy flexibility. When these constraints tighten, repositioning begins even if surface-level indicators remain positive. Behavioral dynamics also play a role. Markets are influenced by collective confidence, which tends to persist longer than fundamentals justify. This creates windows where asset prices remain elevated despite rising underlying risk. Institutions recognize these windows as opportunities to adjust without triggering disruption. Early positioning allows them to reduce exposure gradually, avoiding the forced reactions that occur once sentiment shifts abruptly. Here is the second hook: stability is most dangerous when it feels permanent. Long periods of calm encourage complacency, masking vulnerabilities that only become visible under stress. Institutions that have lived through multiple cycles understand that prolonged stability often precedes rapid change. Their behavior reflects experience, not fear. Liquidity considerations further explain early action. During periods of calm, markets are deep and transactions are efficient. Once stress emerges, liquidity can evaporate quickly, making repositioning costly or impossible. By acting early, institutions preserve flexibility. Gold, with its global liquidity and broad acceptance, becomes an ideal asset for maintaining optionality in uncertain conditions. Risk management frameworks reinforce this approach. Institutional models are designed to limit tail risk, not to maximize short-term returns. These models emphasize scenario analysis and stress testing rather than linear projections. When extreme but plausible scenarios show rising probability, early adjustments are triggered. Gold performs well in these scenarios, not because it predicts outcomes, but because it remains functional across them. The timing of institutional moves often creates confusion. Observers may question why protective assets are accumulated during periods of apparent strength. The answer lies in incentives. Institutions are rewarded for avoiding catastrophic loss, not for matching every phase of market optimism. Early positioning reduces exposure to sudden shocks that cannot be hedged in real time. There is also a psychological advantage to acting early. Institutions that prepare in advance avoid decision-making under pressure. They do not need to react emotionally to breaking news or market volatility. This discipline allows them to remain stable while others scramble to interpret events after the fact. The most revealing aspect of early positioning is what it says about expectations. It signals that risk is being reevaluated, not that disaster is imminent. Institutions are not predicting collapse, they are acknowledging uncertainty. That distinction is crucial. Preparing for uncertainty is not pessimism, it is prudence. Perhaps the strongest hook is this: the public learns from outcomes, institutions learn from probabilities. By the time outcomes are visible, the transfer of wealth has already begun. Early positioning ensures that institutions are not participants in that transfer, but beneficiaries of foresight. Every era leaves clues. Every major financial shift whispers before it screams. This $4 trillion move into gold is not noise, it is a signal. The question is not whether change is coming. The question is whether you will be prepared before the crowd or educated after the damage. Because in every financial reset, wealth does not disappear, it changes hands. And those who listen early don't just survive the shift, they stand strong when others are still trying to understand what happened.